Money doesn't just come from one place. It drips, trickles, flows, and floods into our lives in different ways. Welcome to Drip, Trickle, Flow, Flood, a podcast that explores the power of multiple income streams. We've got merch. That's right. Drip, Trickle, Flow, Flood t-shirts are officially here, and they're as comfy as they are conversation starting. Grab yours at the link in our show notes. Hey, Tony, how are you?
Great. How are you, Melissa?
I'm good. We've got a interesting article we're going to discuss today. This is like right up your alley because you are all about the real estate.
I know. I'm glad I was so wise to send you this article, even though you brought it up today. I don't remember it at all.
Yes. So Tony sent it to me, doesn't remember it. I read it, digested it, broke it down. But we're going to make him work much harder on this episode because this is his wheelhouse of information. So
it takes a team, folks.
It takes
Good thing there's two of us here.
That's right. That's right. So the article, we will link it in our show notes. It is from CNBC, and the article title is, "At 25, she owned 5 rental properties, but says investing in real estate was her number one money mistake. I was really naive." So that's like a very buzzy headline. So essentially, though, what the article is, it's just a first-person account of some of the investing mistakes that this person made. And so what we're going to do is certainly not rail on this person for the investing mistakes that she made, but we're pulling out, like, what are the mistakes that she discusses? These are very common mistakes that happen, especially for first-time or newer investors, and we're going to talk through each one. So the first one is underestimating your total cost. So something that many investors will focus on is that purchase price and not think through all of the other expenses that come with real estate investments. An obvious one is maintenance. Like if the house starts falling apart, that's not great. But also things like taxes, insurance, repairs. If you're using it as an investment to rent, is it going to rent? Is that going to be easy to do? So Tony, talk through this because I'm sure you have lots of advice around here.
Yeah. And I will say that when I got into real estate investing, I was pretty naive, and I learned a lot of these mistakes myself. I would say one, underestimating the total cost. My very first rental, I was renting it out, and tenant moved out, and the city sent me a bill for the water. And I go, well, why are you sending me this? I wasn't paying the water. They go, yeah, the water's attached to the house, not to the individual, so it's on you. It was a big lesson for me to learn that I'm sure this is different in different areas, but in our area, so like gas and electric or phone, internet, those things is on the individual, whoever's name it is. Garbage and water is on the homeowner's name. So I've gone about this a couple different ways. A lot of the time I pay for the water, sewer, garbage. One, you want them having water, sewer, and garbage for just keeping the house maintained. And if they don't pay it, then it would be on me anyway. So I don't always pay it. It kind of depends on the house, on the location, on the tenant, on the pricing, all of those different things. And sometimes it's a combination of things. But so that's one piece of it. The other piece is understanding there's going to be unforeseen expenses when you get into real estate, right? The roof, the refrigerator, a leak, all the different things. I can tell you, I've been doing this for, I don't even want to say it because it tells you how old I am, but 20 plus years now, or 25 years. I'm at about 25 years of real estate investing at this point. I had a bonehead move the other day. My tenant, who's been in this space for years, he's actually the only person that's ever lived in this shop. He locked his battery died on the door code to get into the shop. Neither he nor I knew where the key was to get into that unit. So We've got
My
a
God.
very good relationship. We split the cost for a locksmith to get us in and get a couple keys made. Now we each have a key and we'll keep those batteries up. And that was a pretty small expense. That's probably not going to make or break whether it's successful or not. But you have to understand that there are so many things that go into it and know what you're buying. A house is probably going to have more expenses than maybe a commercial piece of property is. A condo will probably have less surprises because you're only paying for the interior where the HOA would be paying for the envelope. So roof, walls, those sorts of things. The other thing is know what product you're getting into when you're getting your loan. You may be locking in to a 30-year loan and that mortgage is going to be fixed forever. And maybe they're rolling in your taxes and in your insurance into that loan as well. And so you can understand what all those numbers are. If you're getting into some sort of arm, which I think Gary Tice talked about the mortgage lender when he was on, but if you're getting into some sort of 5-1 arm where the rate is variable after a certain amount of time, you need to pay attention to that too, because then your mortgage could actually change, and that could be extremely impactful. So yeah, you got to go in. It's not all sunshine and roses with a house, but if you go in planning for that and you put some money in reserves and you build that in, then it obviously can be a very successful investment strategy. Um,
Is there a certain percentage of money that you should put into reserves for each property?
It really does vary on what you're buying, how new it is. Older homes are probably going to be, maybe you're buying it for less, so maybe your mortgage is less, but you're probably going to have higher repair costs. Newer homes, at least in the first few years, shouldn't have as many expenses. Although I prefer older homes, I feel like their bones are generally better. So maybe you're spending money on little maintenance things, plumbing things that aren't exactly right, kind of annoying things. Maybe you've got to rewire some stuff. But the whole house is probably pretty structurally sound. I buy those commercial shops. I like them because they have very little to break. And so I have to have very little. I really don't even worry about reserves on them because there's generally nothing more than a few $100s that could break. Maybe a hot water tank could go out on some of them that have bathrooms, or maybe the furnace could go out on some of them. But again, generally speaking, it's pretty minor. So we preach education on this show. You've got to get educated about where you're buying, what you're buying, and what those potential expenses could look at. And again, don't get scared off by it. Just pay attention to it and do the math and be conservative on your numbers. If something goes wrong, you're prepared.
All right. So the second one is taking on too much debt. So like over leveraging. And the idea is that heavy borrowing increases risk, especially if, let's say, if we're talking about one of those commercial shops, for example, let's say like you're able to command a certain rental income from the tenant, but then over time that drops. So then what? So talk a little bit about this, as it seems like this could be a big way that investors could get into trouble.
Yeah. So, coming out of 2008, 2009, properties didn't shoot up, but they grew steadily. And then with COVID and everything, they shot up. And, people have a recency bias, and it's easy to forget that real estate doesn't always go up. Rents don't always go up. And so if you're over leveraged and maybe you have vacancy, or maybe, you just have to rent it out for less, and, or maybe it's vacant and now you need to sell it and it's worth less, you can get in a really bad situation. The bank isn't going to lower its mortgage just because the value of that house went down. I'm a proponent of putting down a substantial down payment. It does protect you against those ebbs and flows. Yes, does that mean you have less money to invest? Or I guess it doesn't stretch as far. If you're having to put 20% down versus put 10% down or even 3% down, yeah, obviously you're going to be able to buy less houses, but it does hedge against the downfall. It does let you tolerate some vacancy or even some down rents because your mortgage is going to be less. Or if you do have that equity in the house, maybe you could go do some other loan if you needed to. If you're tapped out, you've been maxing out what lenders will give you. Not only could you be in a bad situation that you're having to fire sale something or you having a hard time making your payments or whatever, you don't have any ability to go borrow any other money. You now become an untouchable uh, borrower. It also puts you in a situation where if you're just buying because you are like, I want to get 100 doors and that's the path I'm on. Not all, not every door is created equally, and just having more doors isn't always the better situation if that debt's going to be crippling. Sometimes the smart move is to be patient, have that money set up so that you can pounce on a good deal when it comes around. And jumping on that good deal could be far more beneficial, whether it's from cash flow or getting a flood of income because you're able to sell it or get a large appreciation, as opposed to just saying, well, I have to get another door, another door, another door. And I think that messaging has been tempered a little bit uh, lately. I listened to some of the real estate podcasts, and for a long time, everybody was talking like the sky can't fall. And it's not like the sky has fallen on the real estate market, but it's certainly softened. There's more vacancies, particularly in the multifamily sector. Single family houses, at least in our area, haven't been impacted that much. They're still very much in demand, but the multifamily that was kind of overbuilt uh, is having a hard time. So if you invested in a large apartment complex, you could be feeding that thing right now.
Yeah. Okay, that brings me to the third one, which is, and we've talked about this a little in other episodes, letting emotions drive decisions. So essentially buying a property because you love it rather than doing the math. I know you've talked about this before, like the math's got to make sense, but I think it's worth repeating in this episode.
Yeah. So I had this one situation where there was a house I was making an offer on, and I was fairly new into my real estate journey, maybe 4 years in, maybe 5 years in, I can't quite remember. But I made an offer on a house, and there was other offers coming in. And my realtor said, if you don't raise your offer, you're not going to get the house. If you don't offer this, you're not going to get the house. And I go, That's okay. If somebody else gets the house, that's great. The seller got more money. The buyer got the house they want. This is what I'm willing to pay for the house. This is what the math says. There's no emotion involved. I'm selling it for this amount. That's not always the case if you're buying the house you're going to live in, or maybe maybe you're buying a college house that your child's going to live in with some roommates. Maybe you're willing to, make a little less to have them in a neighborhood or whatever that you want, or the type of house. But if you're just a straight real estate investor, you have to look at it as there's no emotion involved, right? And the first three rules of real estate are location, location, location. And after that, you need to start looking at the math of, is this thing's going to pencil? And the location is a huge part of that. When I first started buying real estate, I was buying college rentals, easy to rent. And, there was never any vacancy, but lots of turnover, lot of work, lots of repairs, those sorts of things. And I eventually changed what I was buying to get more cute 2 to 3 bedroom houses where you're getting a population of people that are generally going to stay longer. And, in that situation, location, location, location really is a big part of it, right? Because it's dictating who your tenants are, what the rent's going to be. Uh, maybe the location is also determining the age of the homes in the neighborhood and how they're going to appreciate, and maybe how much repairs they're going to take if we go back to the first question. So take the emotion out of it. If this really truly is an investment, you got to treat it like you're buying a stock, like you're buying a bond, like you're sticking in a savings account. The math has to work, and don't get wound up in a bidding war that you're going to lose the property. Um, it's there's going to be more opportunities out there. Be patient and, you know, put that emotion to the side, and trust me, I get it. I hate to lose. I Anytime I'm looking at a property, uh, if somebody else wants it, that means I want it more. I've also had the flip side where someone will want to, I'll be selling a house and then somebody wants to buy it, and I go, well, maybe I don't want to sell it now if they want to buy it so much, and then Lindsay or my partner in it or whoever goes, no, 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 no. Nope. Just because they want it doesn't mean you have to have it. So, it's tough. We're emotional beings, but
Yeah.
you got to just trust the math, trust the studying you've done on this is the house in the location and this is what the number says. Otherwise, yeah, you might end up, the return might be worse, or maybe you end up upside down on it.
Yeah, I think that's a good tidbit that you gave too about like not getting into those negotiations where if you have a realtor who is like, "Oh, but there's all this demand now, you're going to have to put in more." And that makes sense maybe if this is your forever home, you're buying a home for your family, if you're not interested in investing. It's a totally different goal. But for investments, right, you definitely don't want to get trapped into that. So,
Yeah, and I'm not saying you can't bid, and I don't this environment, there isn't as much bidding going on. But I've definitely I've been a part of bidding wars to get a
yep,
house, but I had a ceiling on what I would bid out. I've also lost out on bidding wars because it went beyond my number.
yep.
And you just have to draw a line in the sand there and be okay with moving on.
Some math. Yeah, just you're looking at the math versus, "Oh, damn, I really wanted that
Yeah, and
house."
trust me, especially with like flips with sometimes we were buying the flip, yes, to make money, but also is going to keep the crew busy through the winter. And so buying that
Yeah,
project, you know, it made a lot of sense on a lot of levels, but you still just can't push it too far. Like the math has to work. You can't go in with it, just can't be too tight. Otherwise, you're going to end up regretting it because things don't go up and nothing ever goes exactly as planned. Sometimes you get
yeah.
lucky and it goes better as planned, but rarely does it go exactly as planned.
All right, good advice. So, moving on to the fourth one, skipping proper market research. I know we've talked about this a little bit before, but definitely worth repeating. Things like failing to analyze the location, the demand, the trends, resale value, all of those things. And I know, actually, Tony, what would be good to talk about here is like, that's not always static, right? Like that fluctuates and changes. So, what is some of your best advice for like staying on top of those things when you can't just say, oh, this is an area where things do well? Well, no, that might not be the case in 6 months. So, how do you do that market research? Or what advice would you have for people doing that?
So, and when I do, real estate coaching with people, the first thing I have them do is start getting educated. And I have a few different things I have them do. Obviously, now top on the list is listening to Drip Trickle Flow Flood. Um, I'm joking, but
Okay.
the first thing I have them do is start learning their market. And there's a few different ways to do that. You can get on Redfin, you can get on Zillow, and you can look around what's on the market. I'm a firm believer in still you find a good realtor that knows the market. You set your parameters for what you want to buy. And a lot of that that's a bigger discussion of deciding what you're going to buy. Maybe that's a whole nother episode, but you decide what you want to buy. You're going to set those parameters and they're going to send you every single thing that comes on the market in within those parameters. It's in your inbox. You don't have to do anything. You don't have to remember to get on Redfin and see if anything came on. You don't have to, it's just going to be in your inbox. You click on it, you look at it, and you may only spend, you know, 15 seconds on it, but you're seeing the price, you're seeing the house, you're seeing the location. If it's a little more interesting, you read the description and you can get a little bit more into the weeds. But it's real quick. And I've been doing this for, what did I say? How long? 25 years. I've been having all of these hit my inbox, and I still do today. They hit my inbox and I look at all of them so that when I'm ready to buy something, or when I see something that's a good deal, I know it and I'm ready to jump. I always say what we want to set ourselves up for is to be really, really patient, but have the ability to move at lightning speed. And that's having your funding lined up and all of those different things. But really, it's knowing the good deal when you see it. One of my best purchases, and I still own this house, it was a beautiful sunny day in Bellingham, Washington. And I don't know why they listed this house on a Friday, but everybody was at the lake except for me. And I saw this thing come on the market and I pounced as fast as I could. I got it tied up. They were expecting a bunch of people to call. Nobody did that day. This was years ago. And my offer was going to expire, before Monday came, and everybody was out playing in the sunshine. And so they accepted my offer. And, so just, it is work, but analyzing it, being ready, doing your research. And like you said, these things do change. And so understanding the market really changed here. And that's what drove me into the kind of light industrial stuff that I started buying. It's because the single family houses that I had started with weren't penciling anymore. They shot up in price so much. Rent hadn't gone up at the same rate as the value of the house. And so I couldn't go buy a single family residence and have a pencil. And so I had, that doesn't mean I stopped doing that research. I'm still doing all of that research today. I've just added what I'm researching, and that baseline knowledge is there so that if I see the market shifting, and it has actually, I have seen a few come on that you could just go buy, rent it out, and it would have penciled. And we can talk, again, that's probably enough different episode of what penciled means. But getting the rate of return that you're going to be happy with. And so, uh, yeah, first thing is learn the market, do your research, understand what rents are, understand what your expenses are going to be, and be ready to jump on a good deal when you see it.
All right. And then finally, not having a clear strategy. So investors who don't define their goal, they're making inconsistent decisions, or they're struggling to build wealth. I imagine that this is not just one strategy that hooks over all of your investments, right? It's going to be like an individual strategy for each investment. Maybe there is a broader goal. You can speak to that, Tony. Like, how do you break it down? Because you have multiple properties. So do you have like a big overarching umbrella goal and then an individual strategy for each one, or how does that work?
Yeah, and I would say it has certainly evolved over the years. Like I said, I started off doing college rentals. That's what penciled the best. Um, it took a lot more of my time, but that was okay. I was in my 20s, didn't have a family, so that time was available to go do those other things. Um, so my strategy certainly has changed, and sometimes but you're buying a house for a specific purpose, right? It's got good cash flow, or it's a combination of cash flow and appreciation, or maybe it's mainly an appreciation play and you're hoping that this thing breaks even until you can sell it and get a flood of money. Um, Different properties lend themselves to different strategies, and you know understanding how you want real estate to work for you is important, right? Are you going to buy it, have a property manager manage it, and you're going to be a pretty hands-off person? Well, that's one way to approach it, and that's going to determine what property will work well for that, right? You're going to need probably either a higher you're going to need either a higher margin in, between your expenses and rents to cover that property management fee, or you have to accept that you're going to make less money because it's more of a passive investment. So going in knowing what your strategy is for each house and each property is very important. For me, I have primarily been a long-term cash flow investor, where I'm buying a property and I expect it to cash flow. And as I pay down that debt, and rents go up, that mortgage is less impactful. And, just with natural inflation, and it gets better and better. And eventually, what starts off as maybe a trickle can turn into a flow. And now you can have that be a significant part of your income. Um, I have bought in properties that were flips or whatever, and that is more of a flood type of a play where you're buying it, you're going to have it for a shorter period of time, and you're going to sell it. Um, what I would say is having a bigger toolbox is very important. And with the light industrial stuff, I guess my options are less. There's less options there as maybe with some of the houses. I have always focused mainly on neighborhoods that I really, really like for the houses. I'm buying them with the intention to whatever it is, whether I'm going to sell it, flip it and sell it, or if I'm going to hold it. I always want to have a secondary option where I could buy it and I'm buying it at a price that if it doesn't rent for what I want, I could sell it and still be happy. Or if it doesn't flip for what I want, I can hold it and sell it. And when I was doing construction, we were doing a lot of high end homes, and I would get realtors sending me all these really high end homes to flip. And they go, "Oh my gosh, you could make so much money on this." And they were probably right. There was a lot of opportunity that I passed on, but it didn't fit into my model that there was a backup plan. Had I bought that house, that would have been very expensive, put all that money into it, all that money tied up. If it didn't sell, if the market changed and it didn't sell for what I expected, or I just did my math wrong, or there's unforeseen conditions, I would have been in, a lot of trouble. And sometimes those things take you just a giant financial step back. Where if I'm buying these cute 2-bedroom houses, even if it's a flip, I go, okay, well, I'm doing this, but if I'm buying it for, $350,000 and I'm planning on putting $50,000 into it, I'm gonna have, $400,000 into it, and then I want to sell it for 450. Great. That math all works. Well, again, nothing ever goes exactly as planned, and you've got selling costs and all of these pieces. We had one we bought as a flip. It hit the market March 15th, 2020. Does anybody remember what happened that day? The entire world
Oh
shut
boy.
down. And it was my brother and I doing it. And we said, well, this thing isn't going to sell. And so we pulled it off the market, listed it for rent. Very interesting time to be renting a house. Couldn't even go in the house with the people. But we got it rented. And we still own that house today, and ended up turning into a great rental. And if we hadn't had that kind of secondary strategy with the property, uh, we could have been feeding that thing, until the market went up or things were selling. And in that situation, it probably would have, sold a couple months later. It wouldn't have been catastrophe. But once we got it rented, we were, pretty happy with it. So
All right. Well, that was a lot of
I
really
know
good
that.
info.
Yeah. Next episode, we're going to quiz you, Melissa. They're probably tired.
All right. Well, thanks everybody for listening today. I hope that you enjoyed this episode. And if you'd like, please rate and review on your favorite podcast platform so that more people can find our podcast and have these important money conversations. And with that said, we will see you next time on Drip Trickle Flow Flood. Thanks, everybody.